Hello, everybody. Welcome to today's episode of the Daily Dose. Today is Thursday, November 17th. If you enjoy this type of content, please remember to subscribe on YouTube and follow wherever you listen to podcasts. I come out with an episode like this every day that the market is open, and a longer episode over the weekend that can kind of go into anything, but usually it's more in depth, kind of not really the day-to-day stuff, a little more bigger picture. And that one is definitely worth tuning into as well. So let's get into the markets today. Another down day. I think the markets are kind of starting to see that maybe they got ahead of themselves when it comes to the Fed pivoting its policy. The S&P 500 was down 0.3 today. The Dow Jones was pretty much flat, but down 0.02%, and the Nasdaq was down 0.35. And this is actually up from where we were throughout the day. I know the Nasdaq was down over 1% at one point during the day, but we did still finish in the red. U.S. stocks extended their downtrend Thursday as optimism around easing inflation and a Federal Reserve policy shift waned. Wall Street parsed through a motley of corporate earnings. So, comments from St. Louis Federal Reserve President James Bullard kicked off a down day on Wall Street as he suggested the Fed's monetary tightening campaign has so far had limited effects on observed inflation, and that even a dovish policy from here would need to spike the federal funds rate at least another percentage point. I think it's really interesting. I was actually watching CNBC earlier, and they had someone on there that was talking about how there is a scenario where the terminal Fed funds rate, which just means the peak rate for this cycle, could be in excess of 7%. And I think the market is kind of priced in that 4.6 to 5% range is the highest that the rates will go. But it's definitely possible that they can go above that, well above that even. And I think that would be kind of catastrophic for the markets as far as price goes. And I think that would have a really, really hard effect on just the economy in general. And I don't think that there would be any kind of soft landing in that scenario. Again, that's just one scenario, but it's something that the market hasn't priced in. And I think that the prices that we have seen on the stock market are really just kind of taking into account that best case scenario or that 4.6 to 5% range as the peak. And I think we're kind of getting some more evidence that that might not be the case in the end. Oh, didn't mean to scroll up there. Sorry about that. So, yeah. So, his colleague, Federal Reserve Bank of Minneapolis, Neil Kashkari, echoed that sentiment in separate remarks, indicating he saw little evidence of underlying demand cooling and that the Fed is not there yet on stopping the progression of rate hikes. So we're not close to any sort of policy shift, and I think the market really needs to take that into account and kind of cool off. In the economic data spotlight, filings for unemployment insurance fell last week, holding near historic lows even as a flurry of technology companies report layoff plans. Initial jobless claims, the most timely snapshot of the labor market, came in at 222,000 for the week ended November 12th, a decrease of 4,000 from the prior week, Labor Department data showed Thursday. So that's actually really interesting. You'd expect with this rate hike cycle and all the layoffs that are happening that you're hearing about at all these large companies, you would think that that would lead to higher unemployment, that the economy would look weaker, and that maybe the Fed would start getting pressured to kind of ease off these hawkish remarks. But if we keep seeing data like this, that the job market is remaining historically strong, and we actually saw a decrease in unemployment claims week over week, I mean, that just gives the Fed more evidence and more ammunition to keep staying super hawkish. I mean, they don't have to really worry about anything as far as the labor market goes if this trend continues. And there really hasn't been any sort of major break in the financial system. I mean, I guess you could point to these companies that are laying people off and say, hey, well, these are the biggest companies in the market. They're laying people off. They're not healthy. But you could also make the argument that these companies are overstaffed and that this is just a return to the norm, that there's not easy money in the system anymore, and so they can't continue to be overstaffed like this. You've heard the likes of Mark Zuckerberg saying that he made a mistake bringing in this many people. You saw Jack Dorsey apologize for the layoffs happening at Twitter now because Elon Musk had to lay off so many people, and Jack Dorsey said he brought too many people in. They overhired, they hired too fast. That's what happens when you have easy money for too long. So it's not that the economy's unhealthy as far as that goes, but it's returning to a norm. I think the real glaring red flag is in the housing market because you have these rates going up, and high rates don't always mean that the housing market is unhealthy or that it's impossible to buy a house because you had rates this high in the past. The difference is that the housing uh, home values have appreciated so much over the last 14 years since 2008 that the monthly payments are too high now that the rates are going up. Even with the value of these houses starting to come down, they're still so much higher. There's been so much appreciation since 2008 that now that the rates are starting to increase, the monthly payments that people would have to pay on their mortgage is really, really high. And I think that's why you're seeing home building slow. You're seeing, I mean, wasn't it Wells Fargo a couple weeks ago that said they saw like a 90% decrease in their in people taking out a mortgage? So I think that's really the issue is in the housing market. I think the interest rates are starting to get higher, and the home values are still so high that these monthly payments for mortgages that people would have to take out is still too high. And I think that's the real kind of red flag, if you want to call it, I guess. Right now. And I mean, you could also, I could talk about, I mean, you could talk about this for hours, but also in Europe, I mean, we're debasing other people's currencies against the dollar extremely, and it's causing economic hardship in countries that we're allies with. I won't get too far into this because this is just supposed to be a daily episode, but I mean that there are things happening with interest rates going up too high, but as far as like the Fed's mandate goes, they're really just worried about the job market and stable prices. And they see prices as too high. They think there's too much demand, prices are too high, inflation's too high, and the job market's still strong. So even though they're raising rates faster than they ever have, it doesn't matter to them because everything else is in line as far as their mandates go. I mean, technically not everything is in line, but as far as the Fed's mandate goes, yes, everything is in line, and they are going to continue to raise rates until inflation comes down. A recent rebound across equity markets lost steam Wednesday after strong October retail data offset hopes for a central bank policy slowdown, recently reignited by a string of lighter inflation reports. An earnings miss from Target also weighed on sentiment in Wednesday's session, with the company citing inflation and a deteriorating economic backdrop ahead of the key holiday shopping season. And then it goes on to talk about some other earnings that I don't really care to read about. Meanwhile, in Washington, D.C., Republicans won a majority in the House of Representatives on Wednesday, resulting in split control of the U.S. Congress, a positive sign for investors since stocks have historically performed better in times of political gridlock. Still, strategists have asserted that inflation and economic conditions remain the center of focus for markets. Principal Asset Management Chief Global Strategist Seema Shah said the outcome should be, quote, largely irrelevant to the broad market outlook. Instead, it is historically elevated inflation, the Fed's inflation response, and the resulting risk of recession, coupled with key structural policy decisions that will determine the market's direction. On that front, San Francisco Federal Reserve Bank President Mary Daly said in an interview with CNBC that a rate pause is not currently an option, while indicating the federal funds rate may reach 4.75% to 5.25% range. But Federal Reserve Governor Christopher Waller said Wednesday that recent economic data makes him more comfortable with the possibility of a 50 basis point increase at central bank's December meeting. Goldman Sachs, while projecting a 0.5% hike next month, I do apologize if it said 50 50%. I meant to say 50 basis points. I'm not sure if I did or not. But Goldman Sachs, while projecting a 50 basis point hike next month, added one more quarter point increase in May 2023 to its outlook, raising its expectations for the peak federal funds rate to 5 to 5.25%. So it's interesting. I mean, you have these Federal Reserve uh, speakers, and you have these big institutional investment banks, and they're still raising their range for the peak federal funds rate, even with this inflation data coming in. That's supposed to be good. It's supposed to be good inflation data, and they're still raising those things. So what I've kind of learned the past few years of being in the markets is when it comes to the Fed, they're going to give you kind of uh, a BS answer first. Inflation is transitory. We don't see inflation as a problem. What else? The stimulus isn't going to cause inflation, and then they're like, okay, maybe it's going to be a little bit, but it's not gonna be bad. It'll be gone in a few quarters, and then it's okay. Inflation's a problem, but it's not going to lead to a recession. And then it's, oh, okay, we're going to have to keep raising interest rates faster than we ever have before, but it's going to be a soft landing. And now it's, I don't know if it's going to be a soft landing. Inflation's still really high. That window's closing, and you're seeing the range for the peak federal funds rate keep rising. And I think you just have to be careful. You have to trust what the Fed is saying as far as their goals and policy go, but as far as the long-term outcome, you have to be a little bit cautious, because their job really is they're just trying not to tank the market when they're talking, and so they have to say these things they just might not be realities. So enough of that rambling. Let's take a look at the charts. So S&P 500, I mean, it's in this low range that we have for it. Kind of came down to the bottom today, bounced back up. Um, I'm still expecting to see this come back down. This is a good level of support that it's on right now. So, maybe it bounces back. It's still in this upward trend. I mean, it could still bounce back and come back to the 200-day moving average, but at this stage, I don't really see it going through the 200-day moving average. So we're kind of in that upward bounds of where we could really be at in the S&P 500, in my opinion. I mean, obviously, do your own research, come to your own conclusions, but um, yeah, it is still a little bit elevated for me at this point, especially what the Fed said this week. I expected that from the Fed, but the fact that they're just asserting themselves like this week just reaffirms that their policy is going to remain pretty hawkish, and maybe we're a little elevated on this market. The trend is your friend, the trend's your friend, and the trend tells us we are a little bit elevated and should expect a leg down. So, that's what I'll trust until the trend changes. As far as Bitcoin goes, I just want to start out by saying thank you. I think your name is Rob Bailey, for commenting yesterday. I just like seeing some interaction with the people that are watching, and if anyone else has any comments or questions or anything like that, please leave it in the comments. So I talked yesterday about how all this stuff in FTX really just made me shift my Ethereum to Bitcoin. My crypto portfolio, it's only about 4 or 5% of my overall portfolio, but I moved it to all Bitcoin. From it used to be like a 70% Bitcoin allocation, 30% Ethereum. I didn't say that to kind of trash Ethereum. I definitely think there's a lot of potential in Ethereum. I think if what's his name, Vitalik, if he acts in an ethical manner, and the people that are working on Ethereum act in an ethical manner, I think there's tons of possibilities for it. I think the value of Ethereum could definitely rise exponentially for years to come. But I think what really got exposed in this whole FTX scandal is the danger of this unregulated technology when it's centralized or it's controlled by a person or a couple people. You can see that it can be manipulated, and um, people can get taken advantage of. Um, and that's just something I didn't want to be a part of anymore. Bitcoin is completely different when it comes to that. It's truly decentralized. Um, and my conviction is solely in Bitcoin at this point. So it wasn't really a knock to Ethereum as much as, moving my money where my conviction is. I hope Ethereum lasts. I definitely hope that there's no sort of scandal that comes out in Ethereum, because I think that would just be devastating for the overall crypto market. Um, but yeah, if you have Ethereum, definitely wasn't saying to go sell it or transfer it. That's just personally where my conviction was at. Um, yeah, so that's where I was at with that. But as far as the price action goes on Bitcoin, I'm actually surprised that it's been holding up this well. I was expecting it to be a little bit more aggressive in its sell-off. Like I said, I think there were a lot of people thinking like me, shifting a lot of their crypto assets to Bitcoin, and maybe that helped stabilize it over here. And in addition to this market rally, I think helped stabilize it a little bit. But I think now, if we see another leg down on the S&P 500, and we keep saying exchanges going under, I think that it could definitely continue this sell-off. I mean, to me, there's not really any support here. It's just kind of coiling, and maybe we'll see a sell-off into the 12,000 finally, the 12,500. Anywhere in this range down here, I'm comfortable with putting in a lump sum, which is what I've been waiting to do. Kind of dollar cost averaged through here. But I'd like to put in a lump sum down here somewhere if possible. Again, not financial advice. Do your own research. That's just what I am doing personally. But again, yeah, definitely didn't want to knock Ethereum yesterday. I think Ethereum has a lot of potential, but there are some red flags with it. If you stake your Ethereum, when are you getting that back? You don't know. You don't know when you're getting your money back. You don't know if you ever will. And I just think there's some things there that make me a little bit uncomfortable. That's not really my goal with crypto. My goal really wasn't to like stake and yield farm and all that stuff, which can be very profitable. Again, not saying that that's not a good strategy, just not for me. I think really the thing with Bitcoin is it's I can be my own bank. I can take self custody of real value, of real wealth, energy, all that stuff. And that's something that really draws me to Bitcoin. And so I'll continue to store value in it and stack those sats. And I'm never going to sell. I will never sell Bitcoin. And my conviction has only grown in Bitcoin, and it shrank in Ethereum. And that's why I made that move. So again, definitely wasn't trying to knock Ethereum. I hope it lasts. I hope there's nothing shady going on with Ethereum, and I hope that it lives up to its potential, and I hope the price of Ethereum rises exponentially for years to come. And I wish nothing but the best for the people that are still holding it. That's just what I'm doing. I like to be transparent. So I'll leave it here. I kind of rambled today. I feel like I've been doing that lately. But if you have any questions or comments, please leave them in the comments. Or if you're listening to the podcast, excuse me, reach out to the email. I'd be happy to interact with anybody who listens to the show. Again, it's a newish show, so not a ton of listeners. And as I grow the show, I'll definitely develop new types of episodes. I'd love to do some educational series and some Q&As and some more interactive stuff. But as I just build the base and that kind of thing, this is really my format. But again, thank you for listening. I hope everyone had a great day. I'll see you again tomorrow. And thank you for listening.